Welcome back to CFA Program Exam Preparation. This is study session number 5, reading number 19. Today's topic is capital budgeting. Introduction. Important for long-term projects. Principles adapted for other corporate decisions. Valuation principles similar to these used in security analysis focus on maximizing shareholder value. 2. The capital budgeting process. Steps. 1. Generating ideas. Most important step. 2. Analyzing individual proposals. Gathering information. Forecasting cash flows. Evaluating profitability. 3. Planning the capital budget. Organize profitable proposals. 4. Monitoring and post-auditing. Actual results compared with projections. Project categories. 1. Replacement projects. Easier decisions can be normal replacement of equipment or replacing with technology. 2. Expansion projects. Increase size of business. More uncertain. Carefully considered. 3. New product and services. Upward the uncertainty complex and involve more people in decision-making process. 4. Regulatory, safety, and environmental projects. Frequently required by external party may generate no revenue. Mandatory. 5. Other projects. Can escape project analysis. Pet projects, can be. Some R&D decisions. Can be. 3. Basic principles of capital budgeting. Common assumption and principles. 1. Decision based on cash flow. 2. Timing of cash flow crucial. 3. Cash flows based on opportunity cost. 4. After-tax cash flows analyzed. 5. Financing costs are ignored. Rightward arrow reacted in required rate of return. Some important concepts. Sunk cost, already incurred, do not affect capital budgeting. Opportunity cost, what resource is worth in next best use. Considered in capital budgeting. Incremental cash flow with decision, cash flow without that decision. Externality, effect of investment on other things beside investment, e.g. cannibalization. Conventional cash flow, initial outflow followed by series of inflows. Non-conventional cash flows can flip from positive to negative, or even multiple times. Project interactions. Independent projects, cash flows independent of each other. Mutually exclusive projects, that compete directly with one another. Project sequencing, done through time to create option to invest in future project. Unlimited funds environment, company capable of raising funds for all profitable projects. Capital rationing, limited funds. Rightward arrow allocated to achieve maximum shareholder value subject to funding constraints. 4. Investment decision criteria. 4.1 Net present value, NPV. View the equation. 4.2 Internal rate of return. View the equation. 4.3 Payback period. No of years required to cover the original investment. Cash flows are not discounted. Rightward arrow major drawback does not measure profitability indicator of project liquidity. No decision rule due to lack of economic viability. 4.4 Discounted payback period. No of years taken by cumulative discounted cash flows to equal the original investment. Upward then payback period. Usually, NPV projects. Rightward arrow no discounted payback period. Ignores cash flows after payback period reached. NPV but plus discounted cash flow can happen. 4.5 Average accounting rate of return, AAR. View the equation. Easy to understand and calculate. Based on accounting not on cash flow. Rightward arrow practical limitation. TVM not accounted for. No conceptual criterion of distinguishing between profitable and non-profitable project investments. 4.6 Profitability Index, PI. View the equation. Invest if PI is greater than 1.0. Do not invest if PI is less than 1.0. PI rightward arrow indicates value received against 1 unit invested. Used as guide in capital rationing. Also known as benefit cost ratio. 4.7 NPV profile. Shows NPV as function of discount rates. Y-axis NPV, X-axis discount rates in percent. 4.8 Ranking conflicts between NPV and MIRR. Conflicts arise in mutually exclusive projects. Choose project based on upward the NPV. Projects with different scale can also create conflicts. 4.7 NPV profile. Shows NPV as function of discount rates. Y-axis NPV, X-axis discount rates in percent. 4.8 Ranking conflicts between NPV and MIRR. Conflicts arise in mutually exclusive projects. Choose project based on upward the NPV. Projects with different scale can also create conflicts. 4.9 The multiple MIRR problem and the no MIRR problem. Unconventional cash flows can cause multiple MIRR problem. No MIRR problem rightward arrow no discount rate at which NPV is 0. No MIRR project rightward arrow good investment. 4.10 Popularity and usage of the capital budgeting methods. Larger companies usually use NPV/MIRR techniques. European countries usually use payback period. MBAs prefer using discounted cash flow techniques. NPV criterion most directly related to stock prices. Typically value of company equals existing investment plus NPV of future investments. Impact of investment on stock price is based on expectations. Management's capital budgeting process can demonstrate quality of management and degree to which management up the shareholders' wealth. (5.2) Table format with cash flows collected by type. Another way of organizing cash flows. Cash flows accumulated by type. 5.3 Equation format for organizing cash flows. Initial outlay equals FCINV plus NWC Inc. Annual after-tax OP cash flow equals SCD, 1T, plus D. TNOCF equals SALT plus NWCINV, T, SALT, BT. 6 More on cash flow projections. 6.1 Straight line and accelerated depreciation methods. Accelerated depreciation generally improves NPV compared to straight line depreciation. Modified accelerated cost recovery system, MIRR, is generally used for tax reporting. Assets under MIRR are classified into 3, 5, 7 or 10-year classes. Each year's depreciation calculated through given percentage. Under MIRR depreciation period is assumed to start at middle of year. 6.2 Cash flows for a replacement project. Incremental cash flows are used. Outlay equals FCINV plus NWCINV SAL 0. Plus T, SAL 0 B0. CF equals S, C, D, I, T, plus D. TNOCF equals SALT plus NWCINV. T, SALT, BT. 6.3 Spreadsheet modeling. Capital budgeting usually done on computers using spreadsheets. 6.4 Effects of inflation on capital budgeting analysis. Nominal CF includes effects of inflation. Real CF adjusted downward arrow to remove effects of inflation. Nominal CFS discounted at nominal discount rate. Real CFS discounted at real discount rate. 1 plus nominal rate equals 1 plus real rate, 1 plus inflation rate. With inflation WACC goes up, NPV goes down and MIRR also goes down. If inflation is geared then expected rightward arrow profitability goes down than expected. Increase in inflation decrease in depreciation on tax, saving increases the wealth transfer from taxpayers to government. Higher than expected inflation, increases the wealth transfer from bondholders to issuers. Unequal effect of inflation on revenues and costs. After-tax cash flows will be better or worse depending on how sales outputs and cost inputs are affected. 7 Project analysis and evaluation. 7.1 Mutually exclusive projects with unequal lives. 7.1.1 Least common multiple of lives approach. Life of projects with unequal lives is made equal using LCM. Project with increase in NPV is selected. 7.2 Capital rationing. Done when company has constrained budget. Allocation is done in choosing projects that increase in shareholders' wealth. Projects chosen within budget with increase in NPV. Individual increase in NPV projects rightward arrow not necessarily chosen. Pi is used, MIRR is not used. Misallocation of resources. Potential disadvantage of capital rationing. Hard capital rationing, fixed budget, managers cannot go beyond it. Soft capital rationing, fixed budget but managers are allowed to overspend it under profitable opportunities. 7.3 Risk analysis of capital investments, standalone methods. 7.3.1 Sensitivity analysis. One variable is changed at a time to check an NPV useful in analyzing most influential variable. Variables are plotted on graphs. This analysis is used to establish the most influential variables on project's success or failure. 7.3.2 Scenario analysis. Several variables changed at a time to gauge an NPV. 3 scenarios may be used. Pessimistic. Increase in costs, decrease in revenues, increase R, used to calculate NPV. Optimistic. Increase in revenues, decrease in costs and decrease in R, used to calculate NPV. Most likely. Base case scenario project inputs costs, revenues and R are used to CALC NPV. 7.3.3 Simulation, Monte Carlo, analysis. Procedure of estimating probability distribution of outcomes. Good estimate built by simulating results hundreds/thousand of times. 7.4 Risk analysis of capital investments, market risk methods. Discount rate should be adjusted for market risk. Market risk measure depends on how projected cash flows correlate with market returns. CAPM and APT are used to estimate MRP. CAPM divides total risk into 1. Systematic risk related to market can't be. 2. Unsystematic risk unrelated to market can be. 4. Diversified firm total risk measurement is inappropriate. Asset beta is used to measure systematic risk. SML is used to determine R, which is used as discount rate. Using R rightward arrow NPV greater than 0 and ER less than R rightward arrow if project riskiness increased average company's riskiness, use project R not company's WACC. Using WACC for decreases, increase, beta project overstate, understate, R. If publicly data unavailable rightward arrow use pure play method to estimate beta. 7.5 Real options. Capital budgeting options allow flexibility regarding future decisions. Like financial options but with underlying real assets contingent on future events, option not compulsion. Timing options. Option to delay the investment timing. Sizing option. Abandonment option, opportunity to abandon project when profitable to do. Growth/expansion option, ability to undertake additional investments when profitable. Flexibility options. Price setting option to increase in price when demand greater than supply, capacity. Production flexibility option to add more shifts, working overtime when demand increases in production. Fundamental options. Whole investment is an option. R&D projects are most likely fundamental options. Whole venture decision is based on underlying assets. 7.6 Common capital budgeting pitfalls. 1. Failure to incorporate economic response into investment analysis. 2. Using standardized capital budgeting templates for unique projects. 3. Using normal analysis for pet projects, overly estimating forecasts or undertaking no analysis. 4. Using short-term profitability measures like ROE, NI, EPS instead of NPV, long-term measure. 5. Using ER for mutually exclusive projects. 6. Bad accounting for cash flows. 7. Overestimating overhead costs. 8. Using WACC instead of R for project with risk different than company's average risk. 9. Spending entire capital budget just because it is available. 10. Not focusing on alternative projects which could be profitable. 11. Mishandling opportunity and sunk costs. 8. Other income measures and valuation models. 8.1 The basic capital budgeting model. 8.2 Economic and accounting income. Economic income equals cash flow plus in MV in MV equals ending MV, BEG. MV in MV is also termed as economic depreciation. MV at any point in time equals PV of future CF. Interest is ignored. Economic rate of return is used to calculate MV. Accounting income measured as revenue, expense depreciation based on original cost not MV. Interest is adjusted while calculating it. 8.3 Economic profit, residual income and claims valuation. 8.3.1 Economic profit. EP equals NOPAT, $WACC. NOPAT equals EBIT, 1, tax. $WACC equals capital X WACC. View the equation. NPV equals MVA. 8.3.2 Residual income. RIT equals net, ECT, 1. ECT equals RXBT 1. View the equation. Value of company equals original BV of debt and equity plus PV of RI. 8.3.3 Claim valuation. Estimates value of liabilities/equity claims against assets. Value of company equals liabilities value plus equity value. Value of liabilities equals PV of interest and principal proceeds at RD. Value of equity equals PV of cash flows at RE. In principle EP, RI, and claim valuation results in same valuation. Only measure value of company. Real-world complications. Pension liability adjustments, financial instruments, MV gains/losses, exchange rate, adjustments, rightward arrow, deferred tax, goodwill, inventories, lease. Thank you everyone. We hope this information is useful to you. If you are willing to continue with these lessons, subscribe to the channel. To find more videos, quickly like and share the videos. You can also ask the question in comments, we will happy to answer. This topic ends here. Here is glossary to understand the lectures better. Goodbye.